All right. Hello, everybody. Bill here from the Pinnacle Strategies newsletter. I want to thank you for being a paid subscriber. And what we're doing today is something a little different. The Substack platform, which we use to help produce and publish the newsletter, now allowing us to do videos. So we're going to give this a shot. Hopefully, this information is not only useful, but hopefully it's a little more interactive. It's stuff that you can find more value in. I know I like reading things, but sometimes I like videos too. And hopefully we can find a lot more value in these videos than just, 5 minutes of text. And so let's just get right into it. Today we're going to talk about financial scorecards. And this was something that I wrote about 4 or 5 months ago in the newsletter. And I think this is a powerful, powerful tool for your organization, um, especially if you're kind of a smaller nonprofit and you're just getting started, to give you an idea of how you're doing financially. So let's just get right into it. Make sure we're good. Finance reports. How many of you have this at the top or near the top of your beginning of your board meetings? If you're honest, you're probably raising your hand because 90 to 95% of board meetings begin this way. And there's no rule, there's no law, there's no commandment that says your board meeting must start with a finance report. And it's hard. It's hard to manage a meeting when you start out with the finance report because we want board meetings to have some generative ideas, some positive energy. We want to get down to solving problems. And while some of our problems are financial, looking at a finance report can really take the air out of the room. And some of that is because we don't know what kind of information we want to share. Do we just throw a balance sheet and a profit and loss statement and say, there you go, we made this much, we spent this much, this is where we are? That's great, but how do we figure out that that information changes over time? This information is dynamic. How do we measure it? Because literally when we're taking a look at a finance report, we're only looking at a snapshot in time. There has to be something more that we can do. And there has to be a better way that we can communicate some of this financial information rather than just kind of throwing some documents at folks that aren't accountants and may not understand it. So that's where we can talk about new tools. What if we could create a format that gave us a better understanding of our organizational finances, shows the progression or regression of our financial condition over time, and most importantly, creates metrics that are easy to understand. You don't need to be an accountant or somebody finely trained in business to understand some of the numbers that a financial scorecard can provide. And that's what it does. The answer is a financial scorecard. What it does is it synthesizes data from different statements to show financial conditions of the organization. When you have all of these financial statements out there, what a financial scorecard can do is it can take data from both of those statements, bring them together, and synthesize that data so that you have information that's more useful to you, it's more useful to your board, it's more useful to your organization. And it can provide like a quick 4 or 5 metrics that can show the financial condition of your organization over time. Because you can look at this stuff over time and figure out where things are going, where things have been. And it can be easily tailored to create discussion that can be understood. It's just a wonderful tool. And so before we get into those financial scorecards, let's have a better understanding of our financial statements. The one that we're probably all familiar with is the balance sheet. We also call this the statement of financial position or financial condition. It lists all of your organization's assets and liabilities, and it gives the net worth of your organization at one point in time. Of all of your financial documents, the balance sheet is the most dynamic because it changes the most. If you have any type of financial transaction in your organization today, your financial statement, your balance sheet will change today. It can change every hour if you wanted it to, literally. And so it is a snapshot in one period of time showing where you are, and it doesn't care about your income statement. It doesn't care about your expenses. It just shows your assets and your liabilities at this point in time, right now. The second statement we have is called our income statement, or it's your statement of activities, or your profit and loss statement. This statement starts at a particular point in time, usually the first day of your fiscal year, where you start tracking the income that has come in and the expenses that go out. This is the tool that most folks use to figure out, okay, we're doing well on the income side, or we're doing well on the expense side. A lot of nonprofits, especially if they run from a January to December timeframe, they're going to run a deficit, maybe for the first 10 months of the year, and then through their year-end campaign, make that up, hopefully end up in the black as they go through. Again, that can change on the organization that you have. So your income statement might look a little different than in other organizations. But again, the key is this thing starts on day one of your fiscal year. And when your fiscal year is over, you start a new one. The third statement that's out there that most nonprofit organizations may not have a clear understanding of is your statement of cash flows. The statement of cash flows, like your previous statement, profit and loss statement, starts from a beginning point in time, and it shows how cash is used in an organization, and it categorizes that cash as operating, investing, or financing activities. For most nonprofits, the statement of cash flows basically tells you how much cash that you have on hand at a certain point of time. And that is very critical, especially as you start to plan out what the rest of your fiscal year looks like. So let's get into what this secret sauce of a financial scorecard is, and it's financial ratios. Financial ratios are recognized measurements that take data points from the different financial statements and synthesizes a new set of data that can be measured over time. So we've got this piece of information from our balance sheet, this piece from our statement of cash flows. We bring them together and boom, we've got a new set of data that we can put into our financial scorecard, and that's called a financial ratio. A lot of these ratios are kind of like industry standard. People understand them. And then if you've never heard of them, don't feel bad. I didn't learn about these until a few years ago. But boy, once I began to understand a few of these financial ratios, you can really, really start digging into how you're looking financially for your organization. Let's talk about a couple common financial ratios. First one is revenue per day. How are we doing in terms of bringing in cash? Let's say that we have a small nonprofit and we started on January 1st, and on May 1st, we had $35,000 in revenue. So that's $35,000 on day 120. So that means we brought in roughly $292 per day. On the flip side, we can look at expenses per day. And let's say on that same nonprofit, we've spent $28,000. So $28,000 on day 120 means that we've expended $233 a day. What we've already done is that everybody in your board can understand how much money you've brought in a day or how much you've spent a day. So you could say, ladies and gentlemen of the board, so far this year, we've averaged out $292 a day, and we've expended $233 a day. Financially, we're looking pretty good. Another one that we can do is we can look at our expected revenue per day. So if we've budgeted $200,000 in revenue, we can say we expect to bring in $548 in revenue. And if we've expected to spend $185,000 a year, we can say we expect to spend $507 a day. Right now, we've just created four um, powerful ratios that we can begin to look into a financial scorecard. Here's another one: percentage of revenue budget received. So if we've received $35,000 of our actual revenue against the $200,000 that we expect, we've received 17.5% of our expected revenue. And by the same token, let's say we take that $28,000 that we have spent and we expect to spend $180,000, we've spent 15.6% of our revenue up to this point. Now we can get into some other financial ratios. I think of all financial ratios, this one is probably the most critical: days of operation on hand. With this, we take how much cash we have on hand and we divide it by how much we spend per day. So taking our nonprofit that we have, we know that we've spent about $233 a day in our operation. And if we take the 35,000 minus the 28,000, we know we have about $7,000 left. So if we take that 7,000 and divide it by 233, we have 30 days of cash on hand. We can reasonably expect to operate our organization for 30 more days given our current trends. And this day of operation, this ends up being probably the barometer, the thermometer to figure out how we're doing. If we're an organization that's sitting on about 360 days of operation or more, we can begin to legitimately ask the question, do we have too much cash? Are we leaving too much money on the sideline where maybe we need to start thinking about starting an endowment program? Do we need to make some more internal investments in capital expenditures or our fleet? Those types of things. We've always wanted to bring on this new position. We've got a year of cash on hand. Is now the time to do that? If we're between 180 and 360 days, some of the questions we could be asking are, what are some long-term things we should be thinking to do with our cash? Obviously, we can handle any type of storm that comes for the next 6 to 9 months. Maybe if we start looking at some of this extra cash, we can make some investments in our fleet and some capital, new positions. We could start a small endowment fund. We could do things like that. If we have 90 to 180 days of cash, some of the questions we need to ask are, what are some long-term strategies we need to put in place to strengthen our cash flow? We're in a good spot now, but can we guarantee that going forward? What are some of the strategic things that we need to do now to make sure that we can get above that 180-day threshold and stay there? If we're at 30 and 90 days, what are some short-term strategies that we need to put in some cash flow? We're hanging on. We've got maybe 3 months. Are there some new supporters we need to find, some new grants we need to go after? How can we get some more cash into our organization to help strengthen this days of operation on hand number? And if we're below 30 days, do we continue? This has been a tough slog. What's not working? We really need to have some difficult conversations on whether the work we're doing is really paying off. Another good data point for any type of financial scorecard is our cash reserve ratio. Basically, this gives us an idea of how much cash we have on hand for every dollar we expect to spend for the rest of the year. So if we have our little nonprofit that we set up where we expected to spend $185,000, this year, and we've only spent 28,000. We have remaining budgeted expenses of $157,000. And we also know that we have $7,000 of cash on hand. Brought in 35, spent 28, got 7,000. We have a cash reserve ratio of 4 cents. That means for every dollar that we expect to spend the rest of the year, we have 4 cents to cover that dollar. We need to come up with the other 96. The thing about this cash reserve ratio is that it's best measured over time. As you get closer to the end of your fiscal year, this number should get close or even exceed 1. Basically, it's saying that with all of the money that you have left to spend, you've got enough cash on hand to cover those expenses. And continual growth of this number throughout the fiscal year shows growth of revenues and the expected decrease of future expenses. So this number isn't so much important today as much as it will be next month. If we're at 4 cents now and we're at 3 cents next month, ooh, we're moving in the wrong direction. So here's a way we can create our scorecard. You can take a look. We have our income of 35,000, our expenses of 28,000. We're roughly a third of the way through the year. We've budgeted our percentage of our revenue that we budgeted that we brought in is 17.5%. Our expenditures are 15.6. So we're well below that 32.8 number, which is great on the expenditure side, but I don't know if it's so good on the revenue side. Our revenue per day is $292 a day. Our cost per day is $233 a day. Our cash on hand is $7,000. We have 30 days of cash on hand to operate our organization. Roughly translated, it's 4.29 weeks, and we have a cash reserve ratio of 4 cents. So basically, by looking at these 11 numbers, we've created more data for our organization to look at that makes a lot more sense than just basically a balance statement and a statement of activities. We're getting information that's more useful and more helpful to our finance committee, to our boards, to our staffs, and even to ourselves. And notice that we've created columns that on the first of every month, we can add information and that we can track this stuff over time. So for more information on this, Michael Batts has a great book called Nonprofit Financial Oversight by Accountability Press. He goes into some of these financial ratios. And also, if you ever have a chance to go to Indianapolis and take some classes from Indiana University over there, one of their programs is the Certificate of Nonprofit Executive Leadership. And it's a four classes to earn that certificate, and one of them talks about financial analysis for nonprofit leaders. It's a wonderful program. Take a look at it at philanthropy.iupui.edu. Well, let me know how I did. First time out trying something like this. I feel good about it, but we'll see how it goes. I certainly enjoyed creating this video for you this morning, and please leave me some feedback. Let me know if this was helpful, if this wasn't helpful, if there's some other topics that you want to see covered. I'm more than happy to do it this way than to write something out, again, because I think it has more value. I think it's more interesting, and I think it's just more, it can just have more value for you. So again, let me know what you think. Send me an email, pinnaclestrategiesltd@gmail.com. This is Bill. Thank you very much. Be well.